Let's bring on board our consulting editor, Maithili Bushnarmat. We've also got Sachchidanand Shukla, who is joining in. Maithili, good morning. As we're bracing ourselves for yet another rate hike by the Reserve Bank, are you tilting towards perhaps a 25 basis points rate hike instead of maybe a larger quantum like a 50 basis points? Because as of now, maybe you don't see a compelling case for a larger rate hike at the current juncture?
Well, I think the market is largely factored in a 50 basis point hike, and I think this is what perhaps they will do, either 40 or 50. So the focus this time will be on the quantum of the hike, the RBI's fresh inflation estimates for the present fiscal, and also the accompanying commentary. The problem, Avan, is that the best comparison of the macroeconomy is with the human body. When somebody is sick, if you've forgotten to, or you've delayed or neglected to give him his medicine on time, subsequently pumping him with 10 times the dose will not really help matters very much. So this really is a problem facing the macroeconomy at the moment, at least as far as monetary policy is concerned. RBI was way behind the curve. As a result, it delayed acting at a time when inflation was clearly staring us in the face. There was so much evidence of excess liquidity. So now, whatever they do, you cannot hike more than say 50. You cannot do a 75 basis hike, for instance, but that will be a complete shock to the economy. So today, even if you do a 50 basis point, you cannot really quite compensate for the fact that in the past you were behind the curve. So that really is the problem. Even if they do a 50 basis point hike, we will have to continue the pain the economy, people like you and I, in fact, even more than people like you and I, those at the bottom of the pyramid will have to suffer the pain of higher inflation till such time as the supply chain dislocations are addressed, supply increases, demand is sufficiently compressed. So today, actually, we're paying the price for the Reserve Bank of India's hubris. Unfortunately, as I said, even though the MPC will act today, it will not quite suffice to get inflation back to where it is rightly belong, between 2 and 6%.
Sachchidanand Sanyal, Chief Economist and Head Research of Bandhan Bank, will also be joining us, as will Dr. Sachchidanand Shukla, Chief Economist at M&M. He is with us. I'm going to go across first to him. Thank you so much for being part of our programming in the run-up to the RBI Governor's address at 10 a.m. We just heard from a consulting editor, Maithili Bushnarmat, RBI should have acted before. That has been said not just about India's central bank, but the bank that started printing all of the money in the first place, which is, of course, the US Fed. Going into this scheduled June monetary policy meet, sir, what is your expectations? Which camp are you in? 25 bips rate hike, 40 bips, 50 bips?
So, for all we know, we might be in for a 35 bips. As you know, the governor doesn't really favor the conventional 25, 50 sort of denominations for rate hikes. I would tend to agree with Maithili. I think we are in the middle of a perfect storm with almost whatever that could have gone wrong on inflation has already gone wrong, almost everything. And with nominal GDP growth of 19-20% and your policy rates being at, say, 440, it's obviously too large a gap. And if you look around us globally, everybody has seemingly got religion when it comes to inflation. What I mean is there is fear of God among central banks. And it is really important to maintain price stability. Ignoring inflation for very long can actually have consequences for macro stability, and it can damage longer term growth prospects. But at the same time, like Maithili said, I think it's going to be a case for destination really being more important than the journey. And there is no silver bullet. So, for example, if the RBI were to raise rates by 100, 150 bips at one go, it still won't be enough. It's actually got to be where we want to go in terms of inflation. We want to bring it back down to that corridor where RBI is comfortable. And I don't think there is one silver bullet for that. And therefore, a calibrated approach is really important. And if you look around, there is actually evidence of demand destruction globally. I mean, look at it. The IMF has brought down the forecast, or even the World Bank has brought down forecasts for most 90% of advanced economies, 95 in fact for advanced economies, and 80% plus for the average, for the rest of the world. Growth estimates have been brought down. If I look at lead indicators, again, the evidence is only 10% of the economies that the OECD comes out with a lead indicator for are actually exhibiting an upward trend, and the rest are down. So I think you are having a lot of evidence in terms of demand destruction, but at the same time, we are seeing that central bank actions are still not enough. I mean, look at certain economies like Argentina, even with a 49% say rate, policy rate, inflation is still 10-11% beyond that. So I think we are in a perfect storm, and a calibrated approach and a determined effort to fight inflation is all we need. Back to you.
That's right. It's going to be about the pace of the quantum hikes as well. What the RBI governor's commentary on inflation is going to be. He's promised us a revised inflation forecast for the year as well. Inflation trending anywhere above 2 to 6% of the RBI's previous target. Siddhartha Sanyal, if I can come to you. When I look at the bond markets, or rather I should say when you look at the bond markets, what is it indicating? Is the fastest pace for the hardening of the bond yields, 7.52% for the 10-year overnight. When you look at the yields, everybody says they're unsustainable. But what is it pointing towards? A big slowdown, recession, and quicker, faster, maybe harder than necessary tightening by the governor and the RBI?
That's a very, very interesting question. And actually, at the moment, if I look at the bond yields, in fact, the 10-year yields which are hovering near the 750 mark, that is actually pricing a lot of hikes. Typically, the effective overnight interest rate and a policy interest rate and the 10-year yield, more often than not, the spread is around 150 basis points or at times even lower. Even if I take into account that this is a rising rate scenario, then also it's staggering that at least today, compared to the effective interest rate, overnight policy rate, it's over 300 basis point kind of a spread. So bond market is actually factoring in quite a bit of aggressive hike over the course of the next few months. And my sense is that given that now RBI is clearly focusing on inflation, there will be some bit of front loading of the rate hikes the way we have seen in the month of May, that mid-cycle 40 basis point kind of hike, and some similar quantum of hike is very likely in today's policy also. My sense is that this spree of hikes continue for about the next few months, but beyond the October policy, there will be a situation of reassessing some of the trends globally as well as in India. Like Sachchidanand very rightly articulated how globally some of the signs of demand destruction is setting in from a number of countries, both developed and developing. So it will be very important to take stock once more around that time, that what is the trend on demand, and accordingly what is the trend in commodity prices and inflationary trend. So I think at this moment it's fair to expect quite a bit of front loading of rate hikes, but after the mid of this particular financial year, there has to be a reassessment of the overall situation.
Dr. Shukla, what about tinkering with the CRR? Because clearly the banks have made it quite clear that they don't want liquidity to drop. They've urged the Reserve Bank not to raise the CRR rates any further. But do you think that at a time when you're saying that they're already behind the curve, there's inflation staring us in the face, there's demand destruction woes as well across the globe, that perhaps it is inevitable when it comes to tinkering with the CRR?
So actually, if you look at the systemic banking liquidity, it's about 3.5 lakh crore, which is close to the pre-pandemic levels. And if you look at the neutral level defined by the RBI, which is 1.5% of NDTL, I think we are fairly close to that. And also, if you look at the RBI behavior, they've been stealthily conducting OMO sales for smaller quantum every week in the secondary markets. If you look at the net OMOs, since January, it's been about 14,000 crores. So I think going forward, since we are at that 1.5% to 2% NDTL, close to that level, I don't really think that at this point in time, we need a CRR hike. And banks have already been arguing against it. given the fact that there'll be some sort of liquidity drawdown, credit growth is picking up, I don't really see a need for a CRR hike this point in time. But going forward, if the situation so warrants, the RBI still has that as an option. So I would not really expect a CRR hike in this policy.